Hello, greetings everyone. So myself Dr. Bharath, Assistant Professor from Department of Management from Kristu Jayanti College, Bangalore. So in the continuation of previous video, that is the cost of capital. So in this session, so I am going to give you the detail about how to compute the cost of capital. So cost of capital includes the different source of capital. So in the previous session, so I have given a what are the source of capital. So internal source and the external source. So internal source like the retained earnings, so that is the only source, internal source for the company. External source like equity shares, debentures, preference shares, long term loans from the financial institutions. So I am going to give you the detail about so how to compute each source of finance, external source and also the internal source. So computation of cost of capital. The first one, computation of cost of capital, is the cost of equity. So what is the cost the company is going to pay in a year? The formula for calculating the cost of capital. So there are four types of computing the cost of capital. So we are going to analyze the method of dividend yield method. So in that, how to calculate the cost of equity. So cost of equity is when the company usually in a year they are going to pay the dividends, so that is the cost for the company, and at the time of issuing the shares, normally the share price may issued at a premium or a discount, or they may incur some cost. So that those things all we call it as the net proceedings of the shares. And also we are considering the growth rate of the dividends over the past few years. So these are the three important things when you are calculating the cost of equity. So cost of equity, the formula is the cost of equity equals so dividend expected in the next year divided by so the net proceedings. The net proceedings includes when the company issues shares. If it is a premium, so the face value, for example 100 rupees, if it is a premium, they have issued at a 5 rupees premium, so add the premium. If the company shares issued at a discount, so face value minus the discount. Then if the company incurs any cost, may also call it as the flotation cost. So why the flotation cost? When company issue the shares for the first time, so they are incurring the cost like the postage, then administrative cost, then issuing cost, brokerage cost, commissions. All these costs will be included in the net proceedings. So all these costs put together we call it as the flotation cost. So at the time of issue only, so these costs will be deducted. So the cost of equity so required three things. The one is what is the expected dividend in the next year divided by the net proceedings plus what is the growth rate of the company, dividend growth rate of the company. So over the past few years, so what is the growth rate of the company? So if you apply this formula, you are going to get the cost of equity. The second one, the cost of preference shares. So the cost of preference shares, so there are two types of preference shares company can issue. The one is redeemable preference shares and irredeemable preference shares. Redeemable preference shares. So redeemable preference shares means today the company going to issue the redeemable preference shares. So in that preference shares, the maturity period will be given for that preference shares. After some year, for example, after 8 years or 9 years, those preference shares maturity will be over. So that means at that time you are going to get the principal amount. So in the preference shares, so in the preference shares, the formula is to calculate the redeemable preference shares is, so how much the company is going to pay the preference dividend plus and what is the redeemable value at the time of expiry, and at the time of issue what is the cost, that is net proceedings, and divided by m number of years, and whole divided by the redeemable value and the net proceedings divided by 2. So here the preference shares, whatever the company cost is, the preference dividend they are going to issue then first, and at the time of maturity, so what is the redeemable value they are going to pay. So these are the two important things the company they are facing the cost. So the redeemable preference shares, so these are the two. Then irredeemable preference shares means these shares there is no maturity date, so this can be matured at any point of time when the company wants to mature or redeem any point of them according to their wish. So irredeemable preference shares, the cost is every year they have to pay preference dividend, and when at the time of issue if there is any cost incurred, so for example if it is a premium or if it is a discount or if there is any flotation cost, we need to deduct from the face value. Then the next one, the cost of debentures or the cost of debt. So the cost of debt has two methods, one is redeemable, another one is irredeemable debentures. Redeemable debentures, irredeemable debentures. Here the cost for the company is every year they made profit or loss, they have to pay the interest. So whatever the debentures they have issued, each and every year they have to pay the interest. Also we call it as the coupon rate or coupon interest. Whatever the coupon interest they have given to given at the time of issue, so they have to pay the interest. So that is the main important cost for the company. So then divided by, so if it is a redeemable debentures, in time redeemable debentures, what is the interest they are paying, and we have to deduct 1 minus tax. Why we have to deduct the tax? So when we are paying the debentures interest regularly, so these interest considered as a expenditure for the company. So in that case, whatever the interest we are going to pay, that will be deducted by the tax rate. So the cost will be less. So then the next, irredeemable debentures. So irredeemable debentures, so here there is no specific period for the irredeemable debentures. Whenever the company wants to repay entire the principal amount, so they can give the principal amount. Till that time, each and every year the company have to pay the interest rate. Then the next one, the cost of retained earnings. Retained earnings is the cost is equals to the cost of equity. Why? Because the retained earnings is whatever the retained earnings available funds is for the shareholders only. So that is why the cost of equity is also called it as the cost of retained earnings. For example, if cost of equity is 10 rupees and the cost of retained earnings also is 10 rupees, that means the entire retained earning funds is available for the investors. So then the cost of long term loan. So the cost of long term, so when we are getting external source from the borrowings from financial institutions, the long term loans more than 5 years, so every year we have to make the payment of principal and the interest. So here the interest, when you are calculating the cost, the interest is a cost for the company. So whatever the interest they are paying multiplied by 1 minus T, so that is tax. So tax is also deductible because it's a cost for the company. So the interest whatever they are paying multiplied by the tax you need to deduct, then you will get the cost of long term loan. So after calculating all the 5 costs, each and every specific cost of equity, preference shares, debentures, retained earnings and long term, and so we can calculate the weighted average cost of capital. The formula to calculate the weighted average cost of capital. So first, this is a format. So the format is like this. So the first column is the source of capital. So what kind of source of capital the company raised, whether it's a equity source or a debentures or preference or retained earnings or long term loans. So how much they have raised. So when you normally, so 2 types of values will be given based on the book value, based on the market value. So book value will be available in the balance sheet. So whatever the shares we are going to issue multiplied whatever the so share price. So what is the price of each equity shares multiplied by how many shares we are issued. So the book value or market value will be available. Then how much we raise from the debentures, how much we raise from preference shares, and how much we have retained earnings in our balance sheet, and how much we raise from borrowings. So we need to write each and every amount in the second column, either in a book value or in a market value, and add all the source of finance, and you will get a total entire capital that is available for the company. The next one is weight of each source of capital. So how to calculate the weight? So for example, 100% is a capital. So each source, how much percentage we have raised. For example, equity, how much we raised. For example, equity 50% is a equity, and then debentures is 10%, then preference shares is 10%, retained earning is 10%, and the last one, long term loan, is 20%. So total 100%. So each source, how much percentage of capital we are having, that is going to be calculated using the weights. And the next one, the cost of specific capital. So here the specific capital, so each source using the formula, so we can calculate. So at the time of issue of equity shares in a year, how much cost we are paying. Debentures, how much per debenture cost we are paying. Preference shares, how much preference dividend each year we are paying. So retained earnings, so how much cost we are paying for a retainers. Loans, how much each year we are paying the interest. So each and specific cost will be calculated in the using the previous formulas, and we are going to write the specific source of cost. Then the last one, the column is weighted cost, that is you need to multiply the weights of each source multiplied the cost of specific capital. If you multiplied these two, so weights of equity multiplied by cost of equity, so cost of debentures and the weights of debentures, so if you multiply this you will get a weight cost. Then add all the cost and you will get a weighted average cost of capital, or we can call it as overall cost of capital. What that number indicates? That number indicates, so what is the total cost the company is going to pay each and every year. And if a new project earns more than that percentage, for example, if cost of capital, overall cost of capital is 10%, then the project earns more than 10% of return, then so we can accept the project. So this is the weighted average cost of capital. Rate of return is very important to finalize, to accept the project or reject the project. Now in this session, so we learn how to compute the each source of finance and overall cost of capital. So using this overall cost of capital, so there could be a many decisions can be made. One is the capital budgeting decisions, capital structure decision, dividend decision, and we can compare the decision these rates with the other peer companies. So the cost of capital is very important in the financial management for a company. So taking the decisions for increasing the wealth maximization of the stakeholders. Thank you one and all.